gold is $35 and everything defaults, or whether gold is $35,000 and nothing defaults. The question isn't even, what number will trigger hyperinflation, because the hyperinflation will basically happen when no one with gold wants to exchange it anymore with dollars.
Signature, First Republic, and Silicon Conman Valley Bank. Three banks went bust. Woof, down goes the markets. Woof, gold prices spike. One country after another talking about building up the war against Ukraine. These wars build up again. It goes back to gold. It's the number one safe haven asset in the world. And if you didn't have these cryptocurrencies, gold would be $6,000-$7,000 an ounce now.
The pressure building underneath the global financial system is becoming harder to ignore as cracks appear across banks, currencies, and sovereign balance sheets. The latest discussion highlights how defaults, hyperinflation risks, and the accelerating breakdown of trust in fiat money are converging toward a moment where traditional liquidity tools fail to stabilize markets, when multiple banks collapse, when repo markets malfunction despite unlimited liquidity facilities, and when geopolitical tensions surge simultaneously. Capital inevitably searches for the one asset that has survived every monetary reset in history: physical gold. Rafi Farber, a renowned monetary historian, and Gerald Celente, a seasoned trends forecaster, emphasized that the global system is now oscillating between a deflationary collapse and an inflationary blowout. They argue that the modern fiat era is reaching its mathematical endgame as debt expands far faster than the real economy can support. At the same time, central banks respond with increasingly aggressive tools that push confidence closer to a breaking point. Their combined perspective highlights a world where money printing becomes unavoidable. Interest rates rise despite interventions, and currencies lose purchasing power at an increasingly rapid pace. They point to shrinking Western vault inventories, rising physical premiums, and historically low silver stocks in China as signals of mounting stress beneath the surface. In their view, the transition away from inflationary fiat systems back toward metal-based value anchors is already underway. As confidence erodes, gold and silver regain their role not just as hedges, but as the ultimate basis of settlement when trust disappears. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If there's not enough money for repo and the Fed has a standing facility that they can print whatever cash in exchange for treasuries for anyone who needs it, why is it that interest rates would be rising if they can just print money for anyone who needs the repo? And obviously they can't. For some what reason they call friction, or maybe some regulatory whatever that they can't get around. The standing repo facility just doesn't work. But I don't understand the technicals as to why it doesn't. If we go to default, then that's not just one default. That's a default of everything, because once you have the first default, then whoever is owed that money can't pay back whatever he owes, and then you start a domino and everything falls. And then we go back to $35 an ounce eventually after everything's cleared out. But once we're talking about that, it's not really that much of a difference. If whether gold is $35 and everything defaults, or whether gold is $35,000 and nothing defaults, at what number will trigger hyperinflation, because the hyperinflation will basically happen when no one with gold wants to exchange it anymore with dollars. So what's going to be the final print number for, the final price of gold before the point where no one will sell any for any dollars? And then we'll be in hyperinflation, because once you won't accept gold for dollars, you won't accept anything, and you can't sell anything. I guess we're technically in an infinitesimal reserve banking system, and if you're going to make the fraction infinitesimal, that's where we are. No, I don't think that's going to cause it. I think that's one of the requirements, because the reason that they would eliminate reserve requirements is because they don't want banks hoarding reserves. They want them loaning out, which means that banks don't otherwise want to loan out money. They would rather just not loan it out and hold it there. which means there's not enough demand for the dollars, and that's the impulse for deflation, for falling prices and debt defaults. But in the final stages, or even in the semifinal stages, you have a constant war between deflation and inflation. The natural forces want debt default because all the debt is worthless anyway. And then what the central bank does is say, no, no, you can't default, because if you default, I see the domino, and we're not going to allow that. So they force more spending, but then the currency compensates by falling and falling in value. So the real value of all this new debt keeps falling and falling. I think there's this like famous chart. I know where I saw it. I saw it on Daniel Oliver's last on his speech that he gave to the New Orleans conference. He gave a speech, and he had some graphs, and one graph was the value of the German mark relative to the dollar, like we just saw, you just showed us. But then overlaid on it was the total value of the entire market cap of German marks in gold, and it kept falling and falling and falling to almost nothing. Again, it comes down to the same thing. It's just the mechanics are different. Like
Yeah.
either the value of all this stuff is going to fall in real terms, and then the currency is going to, because the currency is going to disappear because it's backed by debt, and the debt falls. And in which case you have a falling value of market cap of currency, or it's going to fall because of hyperinflation, and you're going to have the same falling value of market cap of currency. 2011 was the gold high at 1923 in September 2011, and then around that time, I don't remember exactly when, but QE3 was 2011, right, when they started the 30 billion a month, and then gold went down for like 4 years during QE3 as the balance sheet was expanding, as they were printing money. Gold went down. So the way that Daniel Oliver puts it is that if QE is being enacted, he doesn't say it exactly this way, but so I'll just rebrand it in terms of my understanding of him, I guess. If QE is being done during a time of falling consumer prices, then you can re-expand the bubble, the asset bubble, and then you have the same effect. Whereas like people put all their money in the stock market, they put all their money in tech, or they put whatever's moving up at the time, they'll put their money in to store it away, and then you'll have a deflationary effect while QE is going on. So a more basic way to understand it is like if you print money to stimulate, let's say, oil drilling, and then all the investment is going into all oil drilling, and then the prices of oil fall because there's so much more supply because of all the money you printed. The supply of oil can go up faster than the supply of money is spreading around generally, so then prices fall as you're printing money. It's paradoxical, but it only lasts so long. But in the current situation is that price inflation, consumer prices are rising, and the banking system is starting to like get a little bit squeaky, and they're going to need more printing while prices are rising, and that really disturbs the psychology. So this time I think QE will affect consumer prices a lot faster, and will hurt confidence in the currency a lot faster, and you'll see interest rates starting to rise even though they're doing QE. Enough physical silver to last my family a year based on 1920s, 1930s prices of basic necessities. Beyond that, I have some, maybe like 60% physical gold stored somewhere with different places with different vaults, different services, that kind of stuff. All physical, no unallocated stuff, and maybe 20-30% miners and streamers, and 5-6 per, like, in the single digits, somewhere in the low single digits, like options and more exotic bets, and about 15-20% cash. Did I count over 100? It might
Yeah,
not be
we get.
exactly
Yeah.
something like that.
Yeah.
Just something vague. The amount of silver at the Shanghai Exchange is like at a record low, or 623 tons, or something, very low number.
Yeah.
So they're not controlling that, but the amount of gold in the Shanghai Exchange is at a record high.
Yeah. So,
But then again, I wanted to just go
yeah.
over this basic principle that it doesn't matter how much money China has. It's like China's not like a unit that we have to worry about. It's not, and even in a more general sense, it's not the amount of gold that a government has doesn't matter. What matters is their ability to inflate. It's the ability to inflate that makes people poor. The fact that a government might have a lot of gold, if it has to spend that gold in order to get stuff that it wants, then that's fine. They'll get stuff as long as they have gold, but whoever they're trading with will demand the actual gold in exchange for the stuff, because they don't trust that country's currency, which they can no longer inflate because the inflationary system is dead, and that's why everyone's gone to metals, which is the money itself. So if they have to spend the gold in order to get stuff, well, that's fine, because eventually they'll run out of gold, and then it'll be homogenized again, and then it'll be fine. So as long as no government can inflate, then nobody can get an unfair advantage, and then governments will just buy what they can until they reach a gold or silver level that they're comfortable with, and they don't want to go lower, and then we can get to an equilibrium again.
The rapid escalation of financial stress, geopolitical conflict, and structural economic weakness is pushing the global system toward a classic flight to safety cycle. Recent bank failures were only the first cracks, and rising pressures in commercial real estate and leasing markets now threaten a broader banking shock. At the same time, war spending, defense buildups, and deepening international confrontations are accelerating currency debasement and weakening long-term confidence in the dollar. Gold continues to respond as the primary refuge, holding above key support zones, while silver follows with renewed momentum. The global landscape has shifted dramatically compared to past cycles. Emerging economies are stronger, the influence of the BRICS is heavier, and the trend of de-dollarization is now openly acknowledged. With interest rates expected to fall and sovereign debt rising uncontrollably, precious metals remain positioned for substantial upward repricing as the monetary system adjusts to new realities. Let's get back to the interview.
Let's go back to 2023, not ancient history, only 2 years ago. Signature, First Republic, and Silicon Conman Valley Bank. 3 banks went bust. Woof, down goes the markets. Woof, gold prices spike. 3 banks. You're going to see 30, 40, 50 banks start failing. Again, we got to go. Trends are born, they grow, they mature, reach old age, and die. COVID was 5 years ago, the war. Now the leases are coming up, and they're not taking all this space back because a lot of people are still working at home, and they're only coming back maybe 3 days a week. They don't need all this office space. There's going to be an office building bust that's going to bring down the bank. No one's talking.
Gold and silver are rising because of geopolitical tensions and central bank buying and all this stuff, but it's all interwoven. It's all in one big picture. So explain to us what's going on, how in the way you see it when it comes to the metals market.
Go back to the Trends Journal, top trends for 2024. Golden year for gold. Gold went up 27, 30%. And then we said Trump got into office, gold prices are going to keep spiking. Go back to October 16th. You could look it up. Go to our YouTube, Gerald Celente or Trends Journal. And I said that gold would go down about $500 an ounce because it really spiked up, and nothing goes straight up or straight down. You have to have it correct. The next day, gold hit $4,379 an ounce. That was the top. The next week, boom, goes way down. $500 it ended up going down. Last Thursday on our podcast, I said gold has to solidify above $4,000 an ounce. Once it finds a solid base over $4,000 an ounce, it's going to keep going back. And as we went on the air, it was at 4,194. It hit 4,245, and it back down. So it stays above 4,000, 4,700, 4,070, 4,100. It's going to keep going up. Same with silver. Again, you nailed it. You made it very clear. It's the geopolitical and socioeconomic uncertainties that are going on. And they're going to keep ramping up these wars. Israel's going to keep ramping up the war against Iran. Ukraine's going to keep ramping up the war. Russia's going to keep ramping up the war. Russia said that no ceasefire, no end to the war. I mean, Ukraine's losing this war. And they're wiping out their energy sources. People have no heat, no electricity. And again, you go back to the Trends Journal on February 22nd, 2 days before the war began in 2022, we said there's no way in the world that Ukraine could defeat Russia. Russia beat the Germans in Operation Barbarossa after World War II. after the Germans killed 25 million of them. And they were the first ones to beat the Germans. What makes you think you're going to be able to beat them? Is Ukraine. So they're going to ramp up. You're going to see a false flag event. Maybe they'll hit a nuclear power plant to get the people to continue this war. And that little, I call him Heil Merz, the little clown boy over there, that's the Chancellor of Germany. Oh, from BlackRock? Yeah, that guy. Germany's been in a recession. This is the third largest economy in the world. In the world. The largest economy in Europe has been in a recession for 2 years. And now this crap spewing out of Mertz's mouth. Oh, we're going to have growth this year. You know what the numbers are? They expect the GDP to grow by 0.2%. What are you kidding me? That's not. Oh, but we're going to borrow $1 trillion to build up our defense, because we have to stop those Russians. $1 trillion. Oh, we're going to build our infrastructure. We could hold a tank. Oh, this is the German. You like World War I? Nah, I like World War II. And look at that little clown boy over there in France, Macron, a little garçon with a pecker smaller than this. We're going to maybe send troops into Ukraine. One country after another, talking about building up the war against Ukraine. These wars build up. Again, it goes back to gold. It's the number one safe haven asset in the world. And if you didn't have these cryptocurrencies, gold would be $6,000-$7,000 an ounce. I think my first buy was like about $168 an ounce, something like that. And I've been following gold since then. And they keep saying that gold prices now are spiking like they have back in the late 1970s and early 80s. There's no comparison. Back then, America was the world leader in many, many different ways. Mm-hmm. Those days are gone. You look at, I forgot the numbers, but China's GDP, India's GDP back then, it was nothing. And now it's like $20 trillion, China's. You look at the BRICS. They've had enough of dollar denomination, and it's going to be the death of the dollar. And gold is dollar-based. So again, the lower interest rates go down, the deeper the dollar falls. The deeper the dollar falls, the higher gold prices go, because it's cheaper to buy in other countries as their currencies are going up. And again, the death of the dollar is coming. This is not the same America as it was back in late 1970. Again, China was nothing. India was nothing. There were no BRICS. So it's a different story now. And so we can see gold prices, escalating very rapidly and much. Trump and Musk said they were going to go into Fort Knox to see how much gold we had there. They'll say, we got more gold. We got so much gold. We're raising the price of gold. They'll raise the price of gold to do away with the debt level. That's a possibility, which would drive gold prices way, way, way. Again, it's a wild card. And a wild card, I've been at this 45 years. Every year we do top trends. This is the only year we had the wild card with Trump coming. So you never know what card's going to be played. Oh, they'll go way beyond it. They'll say it's worth 7,000. They'll make up something.
Right.
Again, they made up the crap. They put it up 70% in 1 year. 70% in 1 year. So what would be 70% increase of 4,000? You can see it go to 10,000.
The current environment shows how quickly financial stability can unravel when structural pressures collide. Bank failures, geopolitical escalation, and weakening commercial real estate markets are forming a single interconnected trend that keeps pushing investors toward hard assets. As office leases expire and companies avoid renewing excess space, major urban markets face a wave of vacancies that threatens the bank balance sheets of those already under strain. At the same time, global conflict is intensifying, with major economies increasing their military spending, expanding debt levels, and accelerating efforts to de-dollarize. These overlapping forces are reinforcing a decisive shift into precious metals. Gold continues to demonstrate exceptional resilience above key support zones, repeatedly absorbing sell-offs and reasserting strength as global uncertainty rises. Silver's behavior mirrors this pattern, responding to both monetary demand and industrial tightness, particularly as emerging economies secure supplies for their long-term strategic needs. This is not a repeat of past cycles. Today's landscape includes rival currency blocks, massive sovereign balance sheets, and a world increasingly positioned for financial realignment. With the dollar facing sustained pressure and confidence deteriorating across multiple sectors, metals remain the most reliable hedge against systemic risk. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.